Hello, and welcome to Module 1 of the Forex Complete Solution Basic Trading course, an introduction to trading. The financial markets are where buyers and sellers of tradable instruments come together at a fixed place called the exchange and at fixed opening and closing times to do business. The prices of these financial instruments, i.e. equities, bonds, forex and commodities, are in constant flux, and this is where the buyers and sellers make their profit. A trader is looking to capitalize on the movement of the financial instrument in which they are trading. The oldest surviving stock index is the Dow Jones Transportation Index, having been formed by Charles Dow in 1884. He opened the Dow Jones 12 Index, now the Dow Jones 30, in 1886. The Dow Jones 30 is a great indicator of strength or weakness in the overall marketplace. When we talk about the stock exchange, we are dealing with the places where stocks are bought and sold between brokers and market makers. Trading in index will depend on what time zone you are trading in. In Europe, for instance, you may want to look at the German DAX 30, the French CAC, the Spanish IBEX, the British FTSE. In the US, the Nasdaq 100, the S&P 500, or the Dow Jones 30. And during the Asian session, the Nikkei, the Shanghai, or the Hang Seng. Bonds are issued so that companies can borrow money with the promise that the money is paid back with interest. Governments do the same thing, offering treasury bonds to create working capital. Bonds are also known as a fixed income security. The futures market are some of the biggest in the world. The modern futures markets were launched in Chicago. They were formed by farmers who needed to agree on a price, often months in advance. To provide liquidity, private speculators were allowed to participate. There was a real physical product such as cattle or corn which changed hands on the settlement day. So the futures market is simply a market where you can trade the underlying product for a settlement price months ahead of time, hence the name the futures market. An option, as the name suggests, gives the buyer an opportunity to buy or sell something at a certain point in the future. The similarity between a futures contract and an option is that the future deal is defined in advance at a set price. Because you have the choice to buy the option, you have to pay for the privilege. So options cost money and you have to buy the option. There are two sides to each contract. You buy a call option and you sell a put option. So an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset at a specific price on or before a certain date. An option, just like a stock or a bond, is a security. The definition of a security is a financial instrument that represents an ownership position in a publicly traded stock or a creditor relationship with a governmental body or a corporation, i.e. a bond or an option. The forex market has an estimated 4 trillion transactions per day. The New York Stock Exchange has an estimated 30 billion transactions per day. The forex market has more transactions than the combined volume of all the major stock market exchanges, futures exchanges, and other financial instruments around the world. It's a huge market. The forex markets are open 24/5, which appeals to many traders. A few advantages of trading forex are: they are open 24 hours a day during the trading week. There are low capital requirements to trade. They're commission free. It is the most liquid market. There's no restrictions on shorting, and there is plenty and constant price action to trade off. The 6 major currency pairs are the euro versus the US dollar, the US dollar versus the Japanese yen, pound sterling versus the US dollar, the US dollar versus the Swiss franc, the Australian dollar versus the US dollar, and the US dollar versus the Canadian dollar. The US dollar is called the currency of first reserve. It is the linchpin of the global economy. It underpins every capital market. As forex traders, this is one currency that you need to understand and follow closely. It is also important to note the order in which of each currency pair. The first currency mentioned is known as the base currency, and the second currency is known as the quote currency. For example, in the US dollar versus the Japanese yen, the US dollar is the base currency and the Japanese yen is the quote currency. The quote number is how many units of the second currency are needed to buy 1 unit of the first. If you are observing the US dollar versus the Japanese yen, and the US dollar is rising, then it means the US dollar is getting stronger and it will cost more Japanese yen to buy the US dollar. So forex deals in lots, which are traditionally 100,000 units of currency. This is known as a standard lot. We have 3 commonly known lot sizes: the standard lot, the mini lot, and the micro lot. As we have discussed, a standard lot represents 100,000 units of currency, whereas a mini lot represents 10,000 and a micro lot 1,000 units of any currency. A 1 pip movement in a standard lot corresponds with a $10 change. A mini lot is a currency trading a lot size that is 1/10 the size of a standard lot. A 1 pip per currency move based in US dollars is equal to a $1 move when trading a mini lot. Mini lots are available to trade. Just ask your broker and they will set up a mini lot account for you. A micro lot is the equivalent to a contract trading for 1,000 units of the base currency in a forex pair. As we have discussed, the base currency is the first currency in the pair, or the currency that the trader buys or sells. Trading in micro lots enables a trader to trade in small increments. When trading forex, be aware of the fundamental news events surrounding your currency pair, and in particular interest rates. All currencies have an associated interest rate, generally set by the country's central bank. A change in interest rate can have an immediate effect on the value of a currency. A rising interest rate generally has a positive effect on the currency. Foreign speculators may seek to purchase the currency whose interest rate is rising to profit on the high rate. When seeking information on a rate on currency rates and currency moves, have a look at the central banks. For instance, if you're looking in America, look at the Federal Reserve. In Europe, the ECB, that's the European Central Bank. In China, it would be the PBOC, that's the People's Bank of China, and the BOJ in Japan, that's the Bank of Japan. So that's to look at your fundamental data and see what the interest rates are set at. And you can also, if you have, if the Federal Reserve, for instance, is releasing news, you will know this in advance. So be aware of the interest rate news coming up, because the market fluctuates wildly during these sessions. So if the Federal Reserve are speaking, or the ECB or the Bank of Japan, you need to be aware when these events are happening, and you can check your economic calendar to view when these events are happening. Also in relation to the strength or weakness of a currency pair would be politics and geopolitics. If there's an election, for instance, we have the US presidential election coming up shortly, the markets will react coming up to that and immediately after it. Okay, so there's always going to be fluctuations on major political events such as an election and that kind of thing. Also, you want to look at inflation data, for example, the CPI data, that is the Consumer Price Index, which is the weighted average of prices of a basket of consumer goods and services such as transportation, food, and medical care. And further fundamental data that you would need to look at would be trade deficits and economic growth, which will both impact the strength or weakness of a currency pair. So whatever currency pair you're looking at, you need to look at the fundamental data. Okay, so if it's the USD, the US dollar against the Japanese yen, you need to look at the two currencies, you need to look at the two countries, you need to look at the political situation. Okay, so there's many situations that will impact the strength and weakness of your currency pair. And again, we have a fundamental module coming up, and we will cover all the news events that you will need to look at when you are trading forex. But again, this is just an introduction to trading, so we're just covering the basics here. And also, with the 6 major currency pairs, be aware of the 2 commodity currencies in the 6 major currency pairs, which are the Aussie USD, the Australian dollar versus the US dollar, and the Canadian dollar against the US dollar. Canada is one of the 10 largest producers of oil in the world. The bulk of Canada's crude oil is exported to the US. So Canada's relationship with oil makes the Canadian dollar a favourite of currency traders who play on oil prices. Historically, the correlation between the Canadian dollar and crude oil is very close. So basically, by following a rising or falling price in crude oil, you should see a correlation with the price rising or falling in the Canadian dollar. This is not to say that it's 100% proof strategy and it will always work, as correlations do break down over time. But just be aware when you're trading a commodity currency of the correlation between the two. It's an intermarket analysis. So if you follow a currency pair, the Canadian, the USD Canadian, and you'll also be looking at a commodity such as oil. So that's an intermarket analysis you'll be looking at if you're placing a trade on that currency pair. And the definition of a correlation in the world of finance is a statistical measure of how 2 securities move in relation to each other. The other commodity currency is the Australian dollar versus the US dollar, due to the economic dependence on precious metals such as gold. So you will also see a correlation with the price of Australian USD and the price of gold, for instance. And another thing to be aware of is the various market sessions when trading forex. The forex market can be broken up into 4 major trading sessions: the Sydney session, the Tokyo session, the London session, and the New York session. The busiest time to trade would be the London and New York session, as these are 2 of the biggest markets. And by busy, I mean you will see massive volume on these markets, because the open of the US session corresponds with the London Open, or not with the London Open, but the London market is open at the same time. So from a European point of view, the cash market in Europe would open at 8 a.m. and on a European time scale, London, I'm talking London times now, the US market would open at 2:30 in the afternoon. But again, when you're trading forex, or trading any market for that matter, you need to know the opening and closing times of the markets. So be aware of the 4 major markets and their opening and closing times to where you are in the world. Okay, and this will also impact the currency pair that you will be trading. Okay, and even the markets you're trading. If you're trading an equity, for instance, if you're from Asia, more than likely you're going to be trading the Shanghai, the Hang Seng, the Nikkei, or the Australian market, because if you're over that side of the world, that would be the market you're looking at. Okay, so when you're over in Europe, you'll have the 2 markets. London and the US will be open at the same time. So if you're looking at a sterling USD trade at that time, there's going to be huge volume on it, because both markets are active at that time. So be aware of the opening and closing times of these markets in correlation to your own location and the times that you plan to trade yourself. Okay, as this will have a huge impact on which currency pair you will be looking to trade. So the London-New York overlap tends to be the busiest time of day, and as we have active traders from 2 of the largest financial centres, London and New York. Even though the forex market trades 24 hours a day during the trading week, choose a currency pair that will suit your own time zone best, okay, and suit also your risk management. And by risk management, I mean the volatile times in the forex market sees huge moves, and if you're comfortable trading those huge moves, there are plenty of trading opportunities. But be aware that the moves can be quite volatile. And again, this is something we cover in future modules, how to pick prices and how to enter and exit the markets. But so just to be aware of the different time zones when you're trading in your forex. So this was our introduction to the basics of of trading. So thank you for taking the time to listen, and I hope you will enjoy our next lesson on the principles of technical analysis. So thank you for taking the time, and we will speak soon. Goodbye.